Hello, everyone, and welcome to another show, the Loan Officer Experience Podcast. KT here. Real business, no chaos, no burnout, and no outdated nonsense. Today, I'm joined by Eddy Perez from EPM, and we're breaking down the FCC's March 4th, Eddy, 2026, coming soon, rule change, and how borrower data is handled and what it means for the next generation of mortgage pros. How are you, my friend? Welcome to the show.
First of all, thank you. Thank you for the time. I'm outstanding, and it's always great to see you and spend time with you. So this is always a lot of fun for me.
Yeah, I know it is, man. And you just have that knack and that ability to really talk to people. And you kind of drop it says it all, right? The chief wrestlers of egos. So, look, you've always done a pretty good job of dropping the ego, speaking truth, even when it's not easy. And sometimes when it's hard for others to hear. And I want to kind of get into that today. I know.
Always, I'm an open book.
Yeah. Well, let's go, man. So the story is, we had changes. They're coming in March 4th, and it's all around the trigger change. How do
Yep.
you feel that that's going to impact first the mortgage broker? If you
So
want to
there's a
start
few.
there. Yeah.
No, that's a great one. There's a few things that are going to change, obviously. Let's start with the pros. And look, some of these cons aren't cons; they're indirect cons. The pro is you don't have to worry so much about your own leads getting pounded and sold by somebody else. And more importantly, what I always worry about reputation, because what happens is when people question somebody's reputation, they're really questioning somebody's character. And sometimes it's getting questioned and there's nothing you can do about it.
Yeah.
So the consumer is not going to get pelted with a gazillion calls. I'm sure I'm not an idiot. There'll be a workaround to a degree somehow. But the thing is, at least it's out there. Biggest impact is what I don't think people have really been watching because of, for the broker community, like we were talking about before, the whole term wholesale, I think is going to take on a new narrative, is because now what's going to really change is how servicing is handled. Because now, ironically, with people with servicing books, now these other companies that used to have to defend their books because of trigger leads now kind of changed the game. So this really helps the big boys more than everybody else. And that's not a bad thing because the big boys have the biggest servicing. The reason I say that's going to affect a mortgage broker is you better believe that every one of your leads is going to be getting called on to get refied or get a new purchase done. Well, then the people are like, well, no. How is that happening? My guy said he's going to give me the lead first. Well, there's this thing called pricing. And over the last year, pretty much even most lenders like myself and servicers are selling off their servicing to one of the 5 or 6, 7 big players. All those guys have retention teams. All those guys not even have passive retention teams. They have active consumer direct. Those leads are going to get sold off. It doesn't really matter. So what I think people aren't realizing is the game has changed, and it's had to change because, with myself, we were one of the last ones that were retaining 100% of our business. Well, we found off the runoff was too crazy. The brokers weren't doing the right thing and bringing them back to us. A lot of them weren't even doing it at all. It was the big call centers that were doing it. And now these call centers don't have to defend their own book. So they're just going to attack everybody else's book. So one way or another, every servicer will have to have some sort of passive retention team or just sell it off, which we're about to start doing a lot. And then they're going to call your customers. However, that is what it is. It's what's happened in the market. It's a big advantage to a couple of the huge players. To the broker, they're going to have to stay in front of their customer, or they're never going to refi them, because what they don't understand is, and consumer direct people are really good at sales, way better than LO. And I was once from that area. They're phone assassins, as I call them. So that's what's really going to affect it, is if brokers really think that their loan is going to stay with them, forget it. That is long gone with this change.
Yeah. And I think that that's been the traditional mindset of the originator, regardless if they're retail or wholesale. That's
Agree?
just always been boots on the ground in the community, typically wins the relationships. And to some degree, I think it still does and it still can. However, I have experienced exactly what you said just in the last, I'd say 18 months more than I've ever seen it in 23 years of doing this. And what I mean by that is, I've had, you know, loans that have been closed with the wholesale lender.
Hmm.
They sell off the servicing. Well, I don't know that they sell off the servicing because I'm just an originator, boots on the ground. And a lot of times I won't see that unless I'm talking to the customer about refinancing. And then when they send me their, you know, their mortgage payment, um, for that month, it shows who the servicer is, right?
Sure.
Now,
Yeah.
a lot of times it is who I closed the loan with, but man, just as many times it seems like it's with a third party servicer.
Hmm.
And depending on what, agreements are made with the wholesale lender that I originally closed it with, really determines if they're, calling that. And man, a lot of times they are. I lost a loan just recently, Eddie, and it was to one of those third party servicers. And man, when you say them guys are assassins, they are very good. Now,
Hmm.
uh, and I mean, I just read an article too. It was, I don't know where the article, don't, I'm saying this tongue in cheek, but it was, I know what I read. It was an article about Rocket Mortgage as an example.
Hmm.
So good at the retention, like 94%, I think is what it said, was their retention rate. Just think about that for a second. That's insane. That's
And
a high.
50% is considered really good. 50,
Mhm.
just so you
Yeah.
know, 50% is really good.
Yeah. And, I have hope though. I do. I really do. I do have hope that as technology evolves, I think one of the things, I think that these direct consumer originators that are really good, on the phone and have a very dialed in process. I do think that originators in the wholesale market have got to get better at those conversations with hands down. However, the technology that these big company, rocket type companies have, I think that technology, and I'm going to ask you your opinion on this as well. But my opinion is it levels the playing field to some degree as AI comes into the marketplace. I
Sure.
think that you could create a call center using AI type of technology
Hmm.
to level the playing field. And it's going to be really the way I envision it is a redistribution of wealth in the mortgage space. What are your thoughts on that?
Look, I come from consumer direct originally when I started my career 24, almost 24 years ago. And we're even looking at not retail, but getting back into consumer direct because I believe it's a whole different animal and it's a better animal. And it's, I think to your point, a cheaper animal today because I think so much can be done by AI and a lot of the times that are wasted can be done there. And I do believe with AI, pretty available and pretty inexpensive for what you're getting. I think more and more people that dial into it are going to do that. I firmly believe the organizations that invest in tech, AI, and even offshoring are going to change it because
Yeah.
speed is actually going to go up a lot higher and costs are going to go down. They're going to get both.
Yep.
And I think what people don't realize is this industry has become a commodity. And as an organization, as an originator, you got to align yourself with somebody who's good, fast, and cheap. Cheap, I mean competitive within 25, 50 basis points. I also think because you can become good, fast, and cheap that, margins, I mean, LO comp will probably go a little bit down just so they can compete faster and harder because they're still going to put in the same amount of hours, but they may be able to close a loan or two more. So I definitely think that's going to happen. And I think the redistribution of wealth is going to happen for the people that embrace those. And it doesn't matter if you have a lot or you have a little. I think you're all going to gain a lot. You may gain a lot more than you have, but I firmly believe that this industry is going to have 50 to 100,000 less people in it within the next 3 to 4 years because it's just not necessary. We've even seen that at EPM because now we're fully outside of these few little niche products. We're almost there. We're 100% broker self-disclose. Well, that's gone.
Yep.
You now have features in the organization that the originators balancing the CD and all that other stuff and COC, that's gone. You don't need that staff. And then underwriting, I think, even though there are pieces that you need onshore, are going to get offshore more anyway, because income and all the major things are going to get done with either AI or offshoring that move at faster speed. Because I firmly believe this industry to really become good, fast, and cheap, you got to become like Waffle House. And I'm talking about us Southerners, so we all get it. You get it. I think you're going to have to be 24/7, 365, because you can do that with offshoring in tech. You can have 2 teams that work 7 days a week, 12-hour shifts, and be able to give this to the customer.
Yeah, 100%. Well, let's go back in time, okay? Because you've been in the business. We've been in business about the same amount of time. Obviously, you've been uber more successful than I have in the space, but
I've
it's
just had a lot of really good people, though. I've
yeah,
had really,
for sure.
really good people.
Yeah, for sure. Well, remember in 2005, we'll use that as an example. We were making margins on FHA loans at 6, let's say 4.5 to 7. Is that fair?
Very
You would
fair.
see that
Even,
on,
on the state, if you were a lender, you didn't have to disclose it, but even as a broker, some states allowed 799 in what was known as Section 32 that nobody knows about now.
right?
Some states had you capped at 4, but yeah, dude, it was 4 to 750 all
It
day,
was.
all
Yeah.
day.
Yeah. And I was a correspondent lender back then.
So you could get to 700 with no problem all
I'd
day.
get 700 all day. Yeah. 6.5 and all day on an FHA loan. It's a long way from 40 or 50 bips that we're talking about today. But the reason I bring that up is because it's the evolution of the changes, right? You look at even the last 24 months, and to even think about anything above, the max comp rate for just brokers in general is 2.75. That's the max, right? Now, if you become a correspondent lender, that changes to some degree for your organization. However, it's still 2.75, and most originators are still doing, on the wholesale side, a lot less than that. I'd say between 1.5 and 2.
Because
And
loan
so,
amounts went up. Everybody doesn't realize that loan amounts have skyrocketed up.
yes. So I think that you make a really good point. It's a new model. And I've been saying this too, man. I've been saying, man, you have got to look at your business a little differently, regardless of how long you've been in the business or how little of time. You have to look at history. We've heard it many times before. History repeats itself. And what we're going to see is a change in business model. I think that we've seen it. It's been gradually, slowly, but surely. And I do, Eddie, I just think we're at a point to where good, fast, and cheap is going to be the new model moving forward.
Well, that happens when you're a commodity.
Yes, it does. And I agree that we are there. And you can listen, there's an argument, well, you can be an advisor. Okay, you can be. And I still think that, you can even charge a higher premium. But it depends on what your goals are. I just think that you can there's gonna be a market for that. I just think it's gonna be smaller. And I think that it's going to continue to die.
So what I think people don't realize is there's just more commoditized than food. You can definitely be Chick-fil-A and be 20% higher, but you can't be 100% higher. And that's what I meant by good, fast, and cheap. Competitive, when I look at those same numbers, you could be about a quarter to 50 in price, not rate, price. However, that's it. Chick-fil-A couldn't charge $14 for their sandwich. Okay? They're 20 to 25% more. That's it. But you also have to understand where they're 20, 25% more. That's overall blended. They're a little bit more on fries, a little bit more on their soft drink, a little bit more on their, milkshake, stuff like that, but they're not on their sandwich. So I'm going to tell people you can't be that crazy on a conventional loan because anybody can do it. You just have to understand, to your point, yeah, you can do that if you're in the first-time homebuyer market. You can do that if you're doing non-QM, sure. But you can't go from 200 basis points trying to make 500.
Yeah.
You can't be 150% above it. You just can't.
Yeah. I really think that, I always use the analogy that I'd rather have 100% or 50% of a watermelon than 100% of a grape. And as I move forward, even in my model, that's kind of the thing, is it's like, how can we do things less expensively that are still good and gives a level of service and is quick. And I do think everything that you said is right on point. Is it here today? I think it's, early adopters are jumping on board with that model. And I think they're going to be very successful, to your point, as they embrace technology. It's going to literally change the landscaping. And then we'll look back up again and people will catch up to that model or that way of thinking. Also, to your point, non-QM is a huge market. That market's growing rapidly in the last, 2 years.
But do you know why?
What?
It's because it's the only private capital.
Yeah.
It's where you can really differentiate yourself as an advisor.
Yeah.
Because that one, it doesn't even have to be 25 to 50. It could be 100 there.
Oh yeah.
In the back end, because the most people don't understand the nuances. And that kind of reminds me when I first got into business, when you had to know 20, 30, 40 different lenders to not lose a product. And that one is private capital. You see, the rest, I tell people this, is 90% of the business done in this country, because they're going to get to about 7 to 10%, is what I call government lending. Like, we are essentially, I jokingly say that I'm a government contractor for housing finance, because if you're doing conventional FHA, USDA, VA, which is about 90% of the market, that's all run or influenced by the government. We're government contractors. I don't think people really recognize that. And that's why good, fast, and cheap is so required there, because it's been commoditized by the government.
Right. Yeah, for sure. So when you talked a little bit about EPM, right? Mm-hmm. And things that you may or may not be doing. How does this affect you guys? Like, what is your thinking from a lender perspective? What is the best, move for you guys as a lender? And then maybe how does that affect the people that you work with?
So, the market's spoken. Price is very, very important. So yeah, we've shifted our model from 100% servicer to servicer and aggregator, like selling the loans off in bulk immediately right after closing. What's that going to do? It's part of the reason I'm having to get a new agreement signed out, because my current agreement says that these customers cannot be called upon. But if I sell it off, I can't influence that anymore. And then the argument people are going to say is like, well, you could if you made that deal. Sure. And 30 basis points in price will be affected, and then you won't send me loans because I don't have it. So I just think originators have to come to the conclusion they don't own the customer, because that is slavery, and that's been going for a really, really long time. So, yep, I'm having to get new agreements signed, because legal flat out said, if you start selling off, you can get sued by your own partners and brokers. And I'm like, whoa. And then what I do retain, I'm going to have a very extreme strictness of a retention team that is passive, not out there reaching out automatically. However, reaching out when I see a payoff, reaching out when there's data out there, when people are shopping but not making it official with a credit pool. And then just really telling all my partners, it's very simple, guys. You bring the loan back to us and we can work with you. And if not, then my team is going to, we're going to give you first look, but then if not, my team has to retain that loan, because pricing already has a couple years built in of servicing values. That's one of the conversations I've had with people. So, and that's not just me. Pretty much everybody's selling off their loans to the 5 or 6 big aggregators. And those aggregators all have active consumer direct, is what I'd say. There's a big difference. And then somebody's going to tell me, this company does it, this company doesn't. Really? Go look at their servicing. They've all sold it off to the Mr. Coopers of the world. Like, those days are gone, guys. Yeah. I hate to say it, they're not coming back. And if you don't want to do business with somebody, and I saw Brandon McKay make this, like, you kind of want the lenders you're doing business with working with you to keep it. And who cares if they kept it? Because I know in situations when I had a retention team, we would keep the loan, and the originator was so angry at us. I said, well, 90-something% are going to the big consumer direct channels that aren't anybody here. And it's like, oh, you would rather us like lose the money, because when you have a retention team, you're not really making any money. You're just trying to keep it on the books instead of losing that revenue. that you've basically forecasted for 4 or 5 years.
Well, you said something that is a very true statement. It's maybe controversial also, but like almost every single wholesale lender sells it off or some.
No, everybody does. I'm just
Yeah.
letting you know,
Some. Yeah.
even retail. There's
Yes.
7 people that buy loans left. There used to be 30.
Yep.
7 left. 7.
Yeah. Now,
Outside
some do
non-
source them. Yeah.
7.
Including you guys. Like sometimes they do keep them and they service them, but they don't service 100% of their loans. It's,
Well,
to
you
some degree, I
can't
would
if
always,
you want to. You can't, KT, if they want to compete on price, which the originator wants. Like,
exactly.
yeah, pricing has gotten really, really sharp. You know why? I'm selling it off, bro, and I'm just
Yeah.
being very radically candid with you.
Yeah.
So is
Yeah.
the competition because they started
Mhm.
doing it a year ago. I
And
held off
hedging,
as
they're
long as I.
hedging to give you those prices, right? To try to, put a little bit more meat on the bone. I get it. Like, but a lot of people don't. And so this is a great conversation to have.
Yeah,
But if you think that your wholesale lender isn't selling those off, they are. They're not going to call them a lot of times. And that's sometimes how these agreements are I've seen are written. Says, well, we're not going to reach out and follow up with them, but they're saying they're not, right? And if they sell it off, they're still not doing it if someone else is. And so you have to really read through those agreements and understand the language, and how they wrap that around.
Mm-hmm.
But, I've always had the mindset that, well, I don't care. They're going to sell them off. Some are going to get sold, some are not, which kind of brings up the next, point is, as an originator, you have to be laser focused on follow up and staying in front of your people and having these conversations, right? Because I always like to tell my database, hey guys, you're going to have people reach out to you. You're going to get offers in the mail, all of these things. Look at them. If you're interested and you want to know if it's valid, reach out to me, because as well as I know, a lot of those offers aren't great. A lot of times they'll have 2 or 3 points, charged to them, to make that a reality. They, if you read the fine print, they got to close in 10 days. They're going to pay 2%, close in 10 days, and they got to have a 780 credit score or higher, which is not most people.
A lot of it's just marketing to get you to call.
It is. Yeah, for sure. But the back end that you're, referring to, it's such an interesting conversation. And no one owns the customer, the best marketer a lot of times will win in these ways and get that business. And so I do think the originator has the advantage, but that's the whole problem, is most of the originators aren't willing to, do the things that are required to keep those customers, but they do have one thing that no one else has, is they have boots on the ground in their community. You know what I'm saying?
Yeah,
and so
yeah.
that's a model. That's a model in itself. You just have to be really good.
And you have to stay in front of them. And I always say this, it's like, you can't get mad that your customer refied with somebody else if you haven't called them. It's kind of like, I had somebody tell me this, is like, just imagine if you had a girlfriend and you quit talking to her, eventually she'd leave you, wouldn't she? I think that what this industry's got to change is you don't own the consumer, because then the question I would tell you is, do you like being owned by somebody else? Like, let's go put the shoe on the other foot. If the other person doesn't call you or treat you well, or look, a lot of people are ashamed when they have to refinance because potentially maybe they got to get cash out. They put some debt, or maybe something's happened in their life. And you got to respect that as a human of what's going on with them. I mean, that's just common decency and just ethics right there.
Well, how do you think this is going to affect the retail originators? They're already at a disadvantage, although I would say a lot of them have become more competitive. They're still not there, but they're closer than they have been previously. But then again, I think that the wholesale channels even moved a little bit, in a positive direction for the consumer as well.
Mhm.
And, we're not here to bash retail. I was retail for almost 10 years.
I had retail.
Yeah, you had retail. What would you say to those retail originators now? Like, I think that the wholesale channel is growing. I think it's going to get bigger. I think it's going to continue to grow. What would you say to those people, knowing what you know now?
Have an open mind. Understand the differences. A lot of wholesale is third-party origination. I firmly believe non-del is kind of a cheat code, kind of the contra code, because you kind of get
We've
the
talked
best of
about
both.
this. Yeah.
You get the best of both worlds.
You do. Yeah. It
You
is.
have a lot more flexibility. You basically, it's cheat code.
I mean, there are literally lenders on the wholesale side that are basically retail.
Yes.
I
And they
mean,
have a
100%.
competitive advantage.
Like, yeah.
And the
So
laws are written to their favor. You know, the laws are written very good to the wholesale favor. Non-Dell is just straight up cheat code, because here's what people don't understand. You know, full blown retail, because of the laws of Dodd-Frank, you have to have so much staffing and departments. It's really expensive. I would just tell those retail originators, like, if you're under the P&L model, you know, go move to the P&L model of somebody that has wholesale or, you know, non-Dell. Or if you don't want to do that, go start your own broker shop and go get your own non-Dell. Cause I've even had some of my own guys that have done that and they're loving it, because it's like, it's almost like the movie Blade, if you remember it. You know, you kind of become the daywalker, all strengths and no weaknesses. You kind of get the ultimate balance and you still have control. That's kind of bananas if you think about it all. I would just tell them that it's really what you want to do. Now, where retail is really strong, and you have to be this honest as an originator. If you want to turn in the file and walk away and everything's handled for you, and I'm not talking about just processing the loan and getting it to the table, your marketing, everything of that nature, bro, then don't leave it. Understand you make a little bit less, but you may make more because of just pure amount of units that you can pump out more. So it's really about your personality. I would just tell them to understand that there are solutions on the third party space. There are fabulous processing companies that basically have that same method. You just have to understand what the differences are. And if you do that, I think, I mean, I'm telling you, this is, I don't know how bold of a statement it is. I said it. I firmly believe in the next 5 years, third party, non-Dell and wholesale will be over 50% of the market, because it was 66% of the market when I used to be in it.
yeah, I remember those days. Yeah.
And I think it can even get higher because the banks are a lot smaller than they used to be.
Thank you for saying that, Eddie. I have been waiting for someone to say exactly what you just said, because no one talks about it in the wholesale channel very often. No one's teaching it to the retail originators. And you're right, man. When we say, if you're listening to this, like, hear me out. When Eddie said non-Dell's the cheat code, it is. It's the only way that I've been set up in the, 10, 13, 14 years that I've been in the wholesale side. That's the only way I've ever done it. And there's a lot of myths around how difficult it is to get to that level. And it's really not. You would be, extremely surprised of how simple it is. But that's the story that retail tells originators. Oh, you don't do non-Dell. It's too much risk. It's the very thing that, like, you realize
Fraud's
you're
your only
asking
risk.
somebody that's doing it themselves, and they're telling you that because they don't want you to do it.
Well, yeah, it's kind of like, oh my God, if I share this information, I'm going to lose people. I've just always believed more in the Gary Vaynerchuk, that if you're very radically candid and you share, it'll all work out for everybody. You just got to be very confident and self-assured in who you are as a person.
Yeah. Well, I love non-Dell. I've been like I said, it's the only way to be. It's the best of both worlds. I think that as we do move forward, it's going to be leveraged more. I think we're going to be doing a lot of education around it.
Yep.
And I think that, there's going to be a lot of opportunity around that once people have a clear understanding of how it works. And so going into the next thing, Eddie, what is it for you, man? Like, what is it that you foresee happening, let's just say in the next 12 months or even 2026 from an industry perspective? What do what's EPM's goals? What do you guys hope to achieve in helping the broker model? And then what do you see as a market entirely in the coming year?
So for EPM is, we're definitely going through what I call a reimage, because I don't think people realize that we can do A to Z, and we do A to Z really, really well. And that we've caught up on the tech, and we've caught up in a lot of and actually advanced on some of the AI compared to others. We just haven't done a really good job of marketing ourselves. So that's definitely going to be changing. And there's still some nuances we have to roll out over the next 30 to 60 days. They're going to be a huge impact because, like I say, I'm full blown ahead on the full blown good, fast, and cheap. All three. I'm not going to pick two. And then as a market, I think wholesale is going to keep growing, or non-del, whatever. I just call it TPO because that's just a whole lot easier. Third-party organizations are going to keep growing.
TPO,
I think the leaders in that industry are going to keep growing. I think more and more of those organizations are going to get bigger and new players are going to come in. Not new players, more people are going to rise up and get bigger. I think you have huge amount of opportunities for growth. But I think we're going to see more of the same. Refi boom isn't coming. I do believe, though, and it was pointed out yesterday, 35 trillion in equity. I think second mortgages and home equities are going to explode. And I think those are a cheat code if you lean into those, because the argument's going to be like, because, people gotten really arrogant. 20 years ago, $200,000 loan, everybody was all about it. Now they're like, if I'm not 450, I'm wasting my time. All right, dude, you're going to be able to close those 150, 200,000 loan. That's really good to your consumer and make great revenue. And it's easy, guys. I used to laugh at how simple these loans are getting closed in 3 to 5 days. Do you really think you deserve something like 10K on a loan that takes a couple of days and all you did was point them in a direction? I mean, guys, the arrogance has to go away. I mean, I remember people saying, a $400,000 A paper loan, 20% down, like, I deserve my bips. And it's like, bro, dude, you barely did any work on this file. The consumer made it easy. So
acting like a bunch of realtors.
Yeah, it's, I think the new guard is going to keep coming in and in and in, and it's going to be really, I think everybody in sales of this industry, to a degree, because it is a commodity, is somewhat of a order taker. The question is, are you going to be a more market driven influencer that knows how to brand themselves to get those orders in the door faster? That's what I really think. Bingo. And there's no shame in that.
Yeah.
Because if you market yourself and you build yourself and you provide that value, that is sales. That's business development. Like, trying to be smooth on the phone, dude, come on, dude. It's a commodity.
Yeah.
It's a commodity.
I got you. Well, for those that are listening, and Eddie, I want you to answer this one last question in closing. Okay. And I appreciate your time today, man.
No, man.
I love just learning from you, man. You got so much knowledge, and I feel like I know a lot of stuff, and then you kind of make it more clear for me.
Well, you can always call me. Everybody can. I love sharing information. It's really, really fun for me.
That's awesome. So you talk about, and this is for those that don't know, I know because I've talked to you enough to know the difference, but when you say the new guard versus the old guard, just talk to the audience about what that means to you.
There's rules. The market has changed, and the market being the macro, things that you can't control. It's nothing about age. People have to understand that because of Dodd-Frank and what happened, and more importantly, quantitative easing, where rates were brought down, the system got rigged, and the system's rigged right now against the originator. However, it doesn't have to stay rigged. And that's going to be a lot in my expose book when I try to publish it here in the next few months. That explains what the new guard does. The new guard is, like I just said, and I will always have my deep love for the originator because I was an originator, and it's still an originator game. It's just like I said, is originators need to understand that they're order takers. And I'm not saying that as an insult. The question is, can you market? Can you understand products? So in other words, your knowledge base needs to go up. There doesn't need to be somebody who's in any niche. And what I mean by that is yeah, if you want to do non-QM or something like that, great, first-time home buyer, but why? The information and the AI is so readily available. You should be able to do A through Z loans. And that's part of the reason we want to be the first lender that can do A through Z, because I want to be there for the originator. I want to be their go-to lender just because I am good, fast, and cheap, and I can cover everything in its borderline one-stop shop. That doesn't mean that I believe I should get 100% of people's loans, because then if I do, I'm just retail. I'm just dressed up retail. So it's just, I want people to have options and all that. And that's what I talk about, the new guard, collaboration, not, this person's a competitor and I want to annihilate them. I think that's just a bunch of garbage. And I think you also have to have an open mind that, yeah, potentially the people you're doing business with will be offshoring jobs, not because of cost, because of culture. Because I do believe a lot of the American workers to this point have become entitled and arrogant about it. And that's why Toyota disrupted Detroit in the GM model, was because all of a sudden quality does matter. Speed does matter. You do have to be good, fast, and cheap. And Japan proved it in the car industry.
Yeah,
Um,
sure did. Yeah. There's a book on that, actually. It's Toyota something. It's a great book about how.
Yeah, I read about it. One of the biggest, there's been 8 or 9 big disruptions, but that's going to be the disruption. Just like Uber disrupted it because taxi cabs smelled like piss, drove like shit, and were assholes. Surprise, surprise. Good, fast, and cheap. That is Uber already. Chick-fil-A, that is even Nike. And people are like, man, those shoes are like $150. Dude, have you seen some of these Gucci shoes for $1,000? But for a sneaker that performs and looks great, it's about being competitive for the value you provide.
For sure.
Yeah. Sure, you can get a
it.
cheaper shoe, but your feet may get torn to shreds. So was it really cheaper?
Or better?
Yeah, you can be all three. And I think that's what the new guard is all about. And it's there, guys. I just saw it at the MBA conference. Out of 138 sessions, 30 were just on AI. If you throw in tech and how to market and brand yourself, it was over 50%. And look, I was one of those that always joked about the pale, male, stale, and frail look. Man, I saw more people in jeans, sports coats, regular attire at an MBA conference than I've seen at any broker show or anything like that. Like, the new guard just somehow showed up at that conference faster than ever, but it was, of course, driven by the tech innovators, just like how the dress code changed is because of the Steve Jobs and the Apples of the world that said, oh, it's okay to be business casual. Just bring your best form. I think that's what it's going to be.
Yeah, I love it.
I think it's going to be a no bullshit approach.
Well, Eddie, if somebody just wanted to reach out and just, spend some time talking to you about EPM and or, market questions, I always felt like you're pretty approachable and pretty easy to get in touch with. What would be the best way for them to do that?
I mean, they got to reach out to my EA. He's the grandmaster of my schedule, because if not, I would overload myself and disappoint a lot of people.
Sure. Right.
His name's, his name's Steve Bradshaw, but his email is J, because his legal name is Johnny first, jbradshaw@epm.net. They can always reach out to me on social. They should follow me on social. My handles are all the same, which is Eddy, EDDY, middle initial G, Perez, Perez, suffix junior. So luckily, because my name is so distinctive like that, even though my first name is Eduardo, that handle, and I'm going by Eddy, and I spell Eddy with a Y, not an IE. And, what I would also tell people right now is, from a cap market standpoint, everybody should be tuned in every day, 8:30, because Phil Mancuso, who I think is the biggest genius in capital markets, is free, guys. And if you can't get there, watch the recording. Like, that is genius stuff that he shares for free. There are people that pay a lot of money for this service. And I'm not knocking those, because those people, I think, provide great value. This one is straight up free. And forget free. I've always said you should charge $1, because people have a hard time not having skin in the game. But this is one of those that, just consider this a gift then. I mean, that's where they could really learn every day.
I couldn't agree more. I was just listening to him just last night, and I thought, man, this dude gets me fired up every single time. And he is, man, he's so knowledgeable, and definitely someone you want to, drink from the same cup from. And he's just got unreal
every
knowledge.
Day at 8:30 Eastern. Every day.
Every day. So guys, new guard, old guard, it isn't young versus old, or, it's about model versus model. It's about culture versus culture. You heard it here today from Eddy Perez, EPM, the man, the myth, the legend. Also, AKA, he's known as the chief wrestler of egos. Eddy, we appreciate your time. Thank you so much.
Always.
Until next time.